Good morning. This is Tuesday, 22nd of July. This is your weekly podcast with Mayor Vilensky at Driving Market. So today we're going to be discussing fiscal stress. What is fiscal stress? What's happening with government bonds, and why is gold and silver moving up? So let's just go a little bit of give you a little bit of background as to what's happening regarding financial monetary system. So the main issue started back already right about 50 years ago, 60 years ago. Is that 50 years ago? Or yeah, when Nixon decoupled the US dollar from the gold standard and then connected it to petrodollars on the condition that the US dollar would be the number one global reserve currency and therefore maintain a level of confidence within the US dollar, the fact that it was king dollar, US number one king reserve currency. In fact, today it still is the number one reserve currency. However, it's under threat and it has a deterioration in its reputation and its ability to maintain its status as the number one safe haven or the number one kingpin in global financial markets. Why is that? Well, again, it started back in the 1970s with Nixon decoupling the dollar from the gold standard, but that was not the first default, essentially, of the dollar. It happened also in 1933 under FDR, where he decoupled the dollar from the gold standard by making it a maximum of so much gold per dollar. That essentially was default number one. Then came default number two, 1970s, and the default number three came in 1985 with the Plaza Accords, where they actually decided to devalue the dollar. There was an official devaluation of the dollar in 1985. So there's been a continuous deterioration, a continuous events at the devaluing of the US dollar. Then came the 2008 debacle of the mortgage backed securities housing mortgage market swap debt, where sent the banks bust, not just Lehman's and Bear Stearns, it sent multiple and multiple small banks bust around the world, and major banks, where they had to merge an acquisition or amalgamate, as they say, with other banks in order to survive. Now, that caused the central banks like the US, UK, Europeans to print billions and billions of fiat currency. Let's talk about the US, to print billions and billions of dollars to pump into the financial system. Who was the architect behind that? Was Jamie Dimon. Jamie Dimon, head of JP Morgan. He went and presented that idea to Paul Volcker, and they accepted it. And the biggest beneficiary, or one of the biggest beneficiaries of that money pump, was JP Morgan. So essentially, JP Morgan saved itself by getting billions of dollars printed to write off bad debt, which they had articulated and eventually they had caused in the financial markets. Not just JP Morgan, it was all the banks that caused this bad debt. And these billions were printed, and as a result of that, the banks were saved. They were too big to fail, and therefore what you had is huge liquidity, which then pushed up financial markets significantly. However, it also caused, by definition, the devaluation of the dollar. How does it cause the devaluation of the dollar? Quite simple. More dollars in circulation, less value per dollar, even though individuals and Joe Public are misled by thinking they've got $1 million in their bank account or $10 million. They think it's worth $10 million. Actually, it's not worth $10 million at all. It's deteriorating and devaluing on a daily basis due to inflation and money printing. So now that you have high inflation, so the purchasing power of your dollar is disappeared. So what do? Well, you copy the central banks. What did the central banks do? In 2008, 2009, they went on a buying spree. A buying spree of what? Of gold. They all began to hoard gold. All the central banks, including China, Russia, Turkey, India, and of course the US and other countries. Now, the UK, for example, as a side point, they got rid of their gold back in 1993. Gordon Brown sold $200 billion of gold at $200 an ounce. What a great move that was. He should be locked away in prison if he was alive. I don't know if he's alive anymore, but that was a disgrace. Selling that in order to facilitate the multicultural approach that Labour had back in the 1990s, which is the effectively the same Labour that you have today in the UK, run by Keir Starmer and those cronies, where they want to destroy the UK, but meanwhile they've got no gold to back up anything as far as the UK is concerned. So the central banks were buying gold by the tonnage. And yet Joe Public is unaware of that. So Joe Public, which is members of the public, are not aware of the fact that central banks, sovereign funds, which act um, inconspicuously, or sorry, conspicuously, covertly, and then you got mega banks all buying gold and hiding it from the public. They're not literally hiding it from the public, they're hiding the fact that they have no confidence in the paper currency, the fiat currency, and that's why they're buying so much gold. But they don't want Joe Public or the members of the public to know that they've got no confidence in the paper currency, because that would cause a run on the banks, and that would cause a run on money moving into gold and silver. Silver's also been moving up. That's a separate topic. So the fundamentals of gold, we all know to go to safe haven in times of crisis. It's also got stored value. It's limited, well sought after precious metal, anti-inflationary, so it's a counter to inflation. But the growth in gold has not been nothing to do with inflation over the last few years. It's been mainly due to huge demand and no supply. In fact, there is a stress going on between COMEX, which is the metals exchange in New York, and that is the paper metals exchange. What does it mean, paper? What that means is quite simple. The paper metal exchange is where you trade the futures, the spot, and options on the metal exchange. So you're actually buying paper. So on paper, you own gold. And then the futures contract, if you wanted to, could convert that from a paper contract into physical gold at the LBMA, the London Bullion Market Association. Now, there's been an uptick in the amount of investors, traders, and buyers of the futures contract in asking for conversion into physical gold. However, the LBMA, the London Bullion Market Association, doesn't have enough physical gold to fulfill the demand, and therefore what's happening is there's now a stress going on between the paper exchange in New York and the actual physical exchange in the UK. Now that physical exchange in the UK doesn't have any gold. Now normally when you trade gold from futures into physical, it's called T plus one or T plus two. T is the letter used for trade date, so they trade it today, and then you get physical delivery in 2 days or 3 days' time. That physical delivery has actually widened to around about 8 to 10 weeks, and that is a major problem. Why is it a major problem? Quite simple. What you have is no delivery of gold, and the LBMA is now allocating 1 kilo of gold to 100 buyers. So 100 individual buyers of that gold bar believe sincerely that they own one gold bar. However, if all of those 100 buyers were to come at the same time to the LBMA and say, please deliver our gold, then that would not happen. There'd be no gold to actually deliver at all to those individuals. So there has been a significant push up in gold as a result of fiscal stress, financial stress, lack of confidence in the dollar, lack of confidence in the euro, and lack of confidence in the pound, to name but a few. So therefore, paper currencies, due to government debt and due to government printing, which will expand going forward, is devaluing the dollar and breaching the confidence that the individuals have in paper currency, which is forcing those investors, traders, and individuals to move into the original metal, the hard yellow metal that they know is always going to have value. And that's why gold has gone up. So is gold going to go up further? Absolutely. Gold, in my opinion, of course, I have to say this for social media, my opinion, is going to go near term to about 4,000, and then from there we're probably looking at next year in 2026, probably looking at about 5,000, 5,500 an ounce, and then upwards from there. There could also be a gold revaluation, and that gold revaluation could push it even higher. Trump may revalue gold to $20,000 an ounce. Of course, all of that we discuss on the mentorship program at Driving Markets. But as far as the deterioration in confidence in paper currencies, that's going to continue. I can see the dollar devaluing by around about 20-30% over the next 2 years. That will push gold even higher. We'll do a separate podcast on silver because that is a standalone subject. But as far as my opinion is, I would be buying more gold, and whether it's the paper or whether it's actual physical, I'd be looking to stay long of gold because I can see it as the number one investment at the moment based on present financial stress and present financial discord. This is Mayor Valensky with Driving Markets on your weekly podcast. You can download it on any of your most favorite platforms. You can also visit us on drivingmarkets.com, the website, whereby we have an array of educational seminars, webinars on how to trade, understand the financial markets. Catch you later.